So James, in your presentation today, you talked about the tremendous increase in value in farmland. In Canada, 2012, 19%. Ontario here, we had 30%. Talk a little bit about what's driving that land value.
Sure. So we have seen large increases in farmland values, especially in Ontario, but also in other provinces, Saskatchewan, Alberta, and Manitoba. And really what's driving those is two factors, crop receipts and interest rates. So crop receipts have been quite good the last several years, probably since 2005, 2006. The run-up in crop prices has really driven crop receipts. And we've also seen a long-term trend in declining interest rates. Currently right now, the Bank of Canada hasn't raised its key interest rates since September 2010. And it doesn't seem like they're going to be increasing it at least for the rest of this year. So that definitely has been supportive for farmland values.
Well, you also talked about the tremendous, investment that farmland has become. Tell our viewers, what I would do with $100 if I invested in a .com in 2000 versus farmland.
Sure. So if you had to take in $100 and invest in the S&P 500 index in the year 2000, you'd have about $100 today. With the stock market recently reaching some new records, you'd actually have a little bit more than $100, but not much. But if you had to take in that, $100 and invest it in Ontario farmland, for example, you'd probably have about $280. So clearly, over at least the last 12 years, farmland's been a better investment.
Yeah, but those returns aren't always there, and I think we talked about farmers probably need to do a gut check about what, before they pull the trigger on an investment, what they need to be able to live with potentially in the years ahead. Talk a little bit about that.
Sure. So obviously, times are great right now. But if we look at the forecast for prices for the next 10 years from either the USDA or Agriculture Canada, both of them have crop prices over the next 10 years declining, not to the previous levels. Corn won't be at $2 in the next 10 years as their projection. But the USDA currently is projecting about corn somewhere between $4 and $5 on an average for the next 10 years. So producers really have to be comfortable, with reduced margins, at least from what they're currently seeing.
Is there a number for you in your mind? Is it you need to be comfortable at 10 or 15% below what you are now?
Sure, yeah. Well, really, each producer should be determining what they're comfortable with. So, but it's always good to do scenario planning. So are you comfortable with a 10% decline in crop receipts, or is it 15, or is it 20%, to allow that your operation to still cash flow that? And you have to also consider, interest rates are low right now, but can you afford a 1 or 2% increase in interest rates, over the next several years to be able to keep your operation profitable in the long term?
Now, it's tough to predict where land prices are going to go in the future, but and whether this is a bubble that's about to burst. But what's your perspective on where things may go over the short term?
Right. So over the last couple of years, we've seen really large increases in farmland values, probably stoked by low interest rates and these high crop receipts. And since we expect crop receipts to come down a little bit over the next few years, we'd expect the rate of increase in farmland values to slow down. We wouldn't expect to see the large increases continue indefinitely. It just doesn't make sense.
Are we thinking more like the rate of inflation or something like that?
Yeah, somewhere around the rate of inflation, but that might be the longer term average. Next year might be a little bit higher, might be a little bit below that. It's really impossible to tell.
Good. Thanks for your thoughts today.
Thank you.